Two people. Same income. Same discipline. Same investment amount of $200 every single month. One starts at 25. One starts at 35. By the time both reach 65, one has $632,000. The other has $379,000. What created a $253,000 difference between two people doing the exact same thing? Not skill, not market timing, not a better broker or a smarter strategy. 10 years. That is the entire difference. A single decade of starting earlier produced $253,000 in additional wealth, and no amount of catching up, no increase in contributions, and no investment strategy available to the average person can recover it once those years are gone. This is the investing mistake that cannot be undone, and the overwhelming majority of people make it without ever realizing the cost. Compound interest is the mechanism behind every long-term wealth figure that seems impossibly large. The principle is simple. Interest earns interest. The growth itself grows. In year one, $1,000 invested at a 10% annual return earns $100. The balance is now $1,100. In year two, the 10% return applies to $1,100, earning $110, not $100. The balance becomes $1,110. In year three, the return applies to $1,210. The earning is $121. The balance becomes $1,331. The numbers feel modest in the early years. That is the deceptive phase of compounding. The growth is always proportional to the base, and the base only becomes significant after years of accumulation. After 10 years, the original $1,000 has become $2,594. After 20 years, $6,727. After 30 years, $17,449. After 40 years, $45,259. The jump from 30 to 40 years, a single additional decade, produces $27,810 in growth. The entire first 30 years produced $15,449. The last 10 years of a 40-year compounding window produce more wealth than the first 30 years combined. This is why time is the single most valuable input in any investment calculation. More valuable than the amount invested, more valuable than the return rate, and more valuable than any financial strategy ever devised. Now the number that most people find impossible to believe until they see the math. A person who invests $200 per month from age 25 to age 35, exactly 10 years, and then stops completely, never investing another dollar, will have more money at age 65 than a person who invests $200 per month every single month from age 35 to age 65 without interruption. The early investor contributes $24,000 total over 10 years and then stops. The late investor contributes $72,000 total over 30 years and never misses a payment. At age 65, at a 10% average annual return, the early investor has approximately $556,000. The late investor has approximately $379,000. The person who stopped investing 30 years earlier, with 1/3 of the total contributions, ends up with $177,000 more. This outcome is not a quirk or an edge case. It is the mathematical reality of what compounding does to money that has been left alone long enough to build its own momentum. The first decade of investing is not just important. It is worth more in isolation than any subsequent 3 decades of identical effort. 5 reasons most people delay investing, and what each one actually costs. Not having enough money yet. A $50 monthly investment at age 25 at 10% average annual returns produces approximately $158,000 by age 65. A $500 monthly investment beginning at age 45 produces approximately $189,000 by the same age. 10 times less money, started 20 years earlier, produces a comparable outcome. The amount invested matters far less than when it begins. Waiting to pay off debt first. For high-interest consumer debt above 20%. This is correct. The guaranteed return from eliminating that debt outperforms any expected investment return. For low-rate debt at 4% to 6%, delaying investment to clear it first has a measurable negative impact on long-term wealth because the investment return exceeds the interest cost. Waiting for the right market conditions. Every decade contains a crash that makes investing feel dangerous. The 2000 dot-com collapse. The 2008 financial crisis. The 2020 pandemic crash. Investors who waited for stability missed the recoveries that followed. Recoveries that produced new all-time highs in every historical case. The S&P 500 has never failed to recover over any 20-year rolling period in its history. Planning to start when income increases. Income level is a weaker predictor of investing behavior than habit. People who do not invest at $40,000 income typically do not start at $80,000. The increase gets absorbed by lifestyle inflation. The habit forms at whatever income level it begins. Not understanding investing well enough. A single S&P 500 index fund requires no financial expertise, no stock selection, and no ongoing decisions. Buy the fund, contribute monthly, do not touch it. That is the complete strategy, and it has outperformed the majority of actively managed funds over every 10-year period in the last 3 decades. The vehicle for long-term compounding does not need to be complex. An S&P 500 index fund holds fractional ownership in the 500 largest publicly traded companies in the United States simultaneously. When one company underperforms, others compensate. The fund automatically rebalances. The historical average annual return over the last 30 years is 10.5%. It is available through Fidelity, Vanguard, and Charles Schwab, with zero minimum investment and expense ratios as low as 0.03%, meaning for every $10,000 invested, the annual fee is $3. The account type in which the investment is held has a compounding effect of its own. A Roth IRA allows after-tax contributions to grow completely tax-free. Every dollar of growth, every dollar of dividend, and every dollar withdrawn in retirement is untaxed. The 2026 annual contribution limit is $7,000. A person who maxes a Roth IRA annually from age 25 to 65 at 10% average returns accumulates approximately $3.1 million and pays zero tax on any of it in retirement. A traditional IRA and employer-sponsored 401k accept pre-tax contributions, reducing taxable income in the year the contribution is made. A person contributing $7,000 to a traditional IRA in a 22% tax bracket saves $1,540 in taxes that year. That $1,540, reinvested, compounds alongside the original contribution. The tax saving itself becomes a compounding asset. Using a standard taxable brokerage account when a Roth IRA is available and eligible is the second most common compounding mistake after starting late. The difference in final balance between a tax-advantaged account and a taxable account over a 40-year investment horizon can exceed the total amount contributed. The cost of each additional year of delay is not linear. It accelerates. At age 25, $200 per month invested to age 65 at 10% average annual returns produces $632,000. At age 30, the same inputs produce $380,000. At age 35, $224,000. At age 40, $132,000. Each 5-year delay does not reduce the outcome by a fixed amount. It approximately halves it. The loss compounds in the same direction as the gain would have. A 35-year-old reading this would need to invest approximately $530 per month to match the outcome of a 25-year-old investing $200 per month. To match a 25-year-old's outcome at age 45, the required monthly contribution rises to over $1,400. The window does not close, but the cost of reopening it grows every year it remains shut. The mistake cannot be reversed, but it stops compounding against the investor the moment the first contribution is made. Every month of delay has a price. Every month of investing, at any amount, begins closing the gap between the outcome that was possible and the outcome that is still achievable. The best time to start was a decade ago. The second best time produces a better outcome than the third best time by a margin that will compound for the rest of the investor's life. Drop a comment with a current age. The next video covers exactly what $100, $200 or $500 a month looks like at retirement for every starting age, with the full numbers laid out so the decision becomes impossible to postpone.